And good morning, everybody.
Good morning.
I also have a couple of coworkers with me here today, Becky Pruitt and Beth Blackston, also there in the back, also from the Illinois Attorney General's office and our Springfield office. If you have questions afterward, maybe we can have time during the presentation regarding activities in our office, I hope Beth and Becky will be able to help me out as well. Foreclosures. Wow. When I talked with Dawn about coming down today, she said, just tell us how this happened. How did we get here? And it's just, I don't know that we can cover that in a 20 or 30 minute session, much less a one-day workshop, much less a one-week workshop. It just seems, if you look at the front page of the newspaper every single day, there's just another issue, another angle, another bank failure, another buyout, another bailout program. What does it all mean? And bottom line, what does it mean for borrowers? There's all this kind of high-level talk about creating investment opportunities and opening up credit in the marketplace. But bottom line, what does it mean for the individual borrowers? Unfortunately, it is unfortunate that with the signing of the legislation yesterday by the president, he actually simplified my job a little bit this morning, because the legislation doesn't mean much as we read it now. And of course, it's 452 pages. I haven't gotten through all 452. I kind of fell asleep at 35. But we have been in conversation with several national organizations like Center for Responsible Lending and National Consumer Law Center and other organizations to get summaries and updates about what this legislation really means. And unfortunately, some of these really wonderful advocacy groups for borrowers like Center for Responsible Lending, National Consumer Law Center, the National Association of Consumer Advocates, NACA, we're on the Hill trying to get provisions for borrowers, protections in this latest legislation, things like bankruptcy relief, income tax relief, and I'll explain both of those, and required modifications that servicers offer modifications to borrowers who are in trouble, moratorium on foreclosure, meaning stopping foreclosures for a period of time until borrowers were offered modifications. And none of those provisions, unfortunately, made it into the pending legislation, to the legislation that was signed by the president. I think that, if I'm correct, I think Jack Porter might be talking a little bit later, or some of the CIOP organizers and leaders talking later about what we can do and what protections are needed moving forward. We've also, got some other big, national picture, even prior to the legislation signed yesterday by the president. We had the Fannie Mae and Freddie Mac situation and the federal government coming in for the takeover there. Right now, we don't know that means anything, again, for individual borrowers. What we are looking at there is that Fannie Mae and Freddie Mac aren't actually lenders, okay? They are private corporations that receive some government funds. They're called GSEs. They receive government funds, but they're private companies that will purchase loans on the secondary market and facilitate the purchase of loans on the secondary market. Some of you who may already be working with borrowers, some leaders in the community who are facing foreclosure, who run into borrowers who have Fannie Mae or Freddie Mac backed loans or purchased loans, may know that in the past it's been very difficult to negotiate to get better loan terms because Fannie Mae and Freddie Mac have been the investors, and they've had some very tight restrictions on the types of loan modifications they would allow. I'm told that by some folks on the Hill and some other folks in Washington that within a short period of time, a couple of weeks, we should be seeing additional, sort of new provisions that will allow Fannie Mae and Freddie Mac-backed mortgages. The servicers will be allowed greater flexibility in terms of what they can do to work with borrowers. But we haven't seen them yet. That's still yet to be seen. So really the only thing we have right now is something called the FHA Modernization Bill. And that was passed and signed by the president in late July. And right now that is, and it's actually called let me get the exact name. The Foreclosure Prevention Act of 2008. Simple enough. Foreclosure Prevention Act. It has in it, and it actually went into effect October 1st, just a couple of days ago. It has in it a provision for a program called Hope for Homeowners. And what this Hope for Homeowners program is, and that was actually about a 600-page piece of legislation. All the lawyers and politicians, you got to keep them employed, so they get paid by the word. But it has a Hope for Homeowners program, and what this Hope for Homeowners program is it's an FHA loan program to help people refinance who are at risk of foreclosure. And the major provisions of that program are that for people who are in trouble, who have loans where they might be behind in their payments, they might be what we call upside down on their property, meaning that what they owe on their home, they owe more than the house is worth. They can apply for one of these new FHA Hope for Homeowner loans. And the loan, well, in terms of the underwriting criteria, the parameters, the requirements of the loan, are such that the amount of the loan cannot be more than 95% of the home value. Well, as we're seeing particularly in, it's nationwide. It's not just in California, it's not just in New York. We're definitely being hit in the Midwest as well, maybe not as drastically as the coasts, but we're definitely seeing it, and we're seeing it in our office, particularly in central Illinois. A lot of people are underwater. They owe more than the house is worth. So in order to qualify for this program, a borrower would have to get their current lender to agree in a refinance transaction to take less than what the lender is owed, what we call a short payoff, in order to be able to get the new loan. Because the new loan, the amount of it, cannot be more than 95% of the current home value. Does that make sense to folks, or should I explain it? Okay. That's really difficult for those of you who are already working with borrowers or who you yourselves might be in trouble in this market, because I think we probably have a little bit of both in the audience. Trying to work with lenders right now to get them to reduce the principal balance of the mortgage, to get them to take less money than it actually is owed. And the reason people may be upside down on the property might have most likely has nothing to do with anything that the borrower did. Some of it is market forces, that there's just been depreciation in the market, a decline of property values, but it could have been, and very likely, tied into the predatory lending crisis, which is that the homes were overappraised to begin with. They were never actually worth what the lenders said they were worth. So now you get the lender overappraising the property and making the loan on the front end, and then not willing to sort of fess up and say, yeah, the property really isn't worth that, we'll take less than a payoff. They're not willing to take principal reductions. So in order to take advantage of this Hope for Homeowners program, all of a sudden you have to convince the lender to take less money for a payoff, something that is only voluntary under the legislation. The other parameter is that the loan has to be, or the payments on the loan cannot be more than 31% of a borrower's gross monthly income. Now, there's a protection that is considered to be a protection for the consumer, and it is a good protection in terms of trying to limit so that people don't get into trouble again, that you create some sort of fence, some sort of protection, so that because one of the problems of this whole predatory lending mess that we're in is that people were given loans they couldn't afford from the get-go. The lender said, don't worry about it. We'll inflate your income a little bit on the application, we'll kind of put it through, but you'll be able to make the payments. Here, look at your budget. You'll be able to kind of squeeze out a little bit more money to be able to make your housing payment. If you really want a home, this is what you have to do. Don't worry, home values will go up. You'll be able to refinance in a year or two, and your payments will go down, interest rates will go down, everything will be great. Well, there's a parameter on this program that you can't spend more than 31% of your gross household income every month on your mortgage payment. Not necessarily a bad thing, but when you consider